Hey, welcome to this video on support resistance trading strategy. This is Barry Burns with TopDogTrading. And have you ever wondered how to determine when the market will stop moving in one direction or another, or whether it will continue to move, when it'll bounce, etc.? Well, support resistance levels can definitely help you with that, and today I'm going to show you a little bit of a not sophisticated technique, but a little bit beyond the basics. So we'll go into a few different details that'll help you to understand not only how to apply these, but why they work, that there's an actual reason they work. I call market logic. So first of all, here we have a intraday chart, and I'm going to apply what are called floor trader pivots. So there we go. And these floor trader pivots I consider to be very, very good and important support resistance levels. So that begs the first question, why do they work? They work because a lot of people use them. That's the market logic, if you will. There's a lot of things out there people will teach you saying, oh, trade this moving average crossover, trade this, trade that. And that's all fine, but you should always ask, but why does it work? What's the market logic? In other words, when I talk about market logic, I'm saying the market participants are the ones who move the market up, move the market down. And they buy, they sell, they get excited, they get despondent. So what about the strategy that you're being taught would actually cause or reflect what the market participants are doing, the people actually doing the buying and selling? Because that's what creates tops and bottoms and little peaks and valleys. So there needs to be a reason. So the reason that floor trader pivots work is because they've been used for many, many years, and a lot of people use them. So some people say to me, yeah, but that's just a self-fulfilling prophecy. And my answer to that is, well, what better reason for them to work? Of course they're a self-fulfilling prophecy. That's why they work. Don't diminish that. Actually put an exclamation point next to that. That's why everything works in the market, is because people are buying or selling. And so if a lot of people are looking at something, it's more likely to have an effect on the market. So for example, with floor trader pivots here, first of all, I consider this a very, very good tool using support resistance because the numbers are static. In other words, the numbers are what the numbers are. There's a mathematical formula. You can look it up on the internet. It's very common. And that mathematical formula produces solid numbers. So these numbers are going to be the same numbers everyone sees. So right here, that's the pivot point or the central pivot. And everyone who uses the standard formula at least is going to have that same number. Everyone, every market participant. Yesterday's close, there's yesterday's close, and that's going to be the same for everybody. That's very, very important. Yesterday's low, that's another just rock solid number. The low is what the low is, and you can check the exchange websites and you can get that number if you need the official number. Support level 1, that is again a solid number. It's not going to be different for different people. It's going to be the same number for everybody. So therefore, market participants will look at that and it will have an effect. And then we have what's called the mid pivots. So this is halfway between the pivot point and S1. And I use those as well. Not everybody uses those now. I'll be clear about that. I find them very helpful. So these static numbers are very important. You just lay them over your chart and away you go. All right, now that's great. Let's talk about another type of support resistance level to put on top of this one. Because what we're talking about today are clusters of support resistance. So another common tool used, I'll go up here if I can. Okay, there we go, finally got it. So I'm going to go to my Fibonacci retracement levels. And we'll just draw from this high here to that low there. And this measures how far the market retraces back to the original point. So in this case, we are measuring an impulse move from this high of the morning, to the lowest low of the morning before lunchtime. And so that's it. And then it draws these percentage retracements. How far does it retrace? If it retraces 0%, well, 0. 23.6%, 38, 50, etc. Now, Fibonacci levels are also great because, again, a lot of people use them. However, they are not as reliable as floor trader pivots. Why? Because while floor trader pivots are solid numbers for the day, and they're going to be that for everybody. Everybody has the same numbers, as I mentioned. Fibonacci levels are not going to be the same for everybody. Why? Because it depends on which highs and lows they use for drawing the Fibonacci retracements. So somebody might do it like I did here. Another person might do it from, say, here to here. Another person might draw it from a bigger term chart, maybe a 5-minute chart, maybe a 20-minute chart, maybe a daily chart, a 60-minute chart, 30-minute chart. And so they will get different levels. And for that reason, there's not as much of a self-fulfilling prophecy. So the bottom line is not as many people are looking at the same numbers, the same levels. And therefore, they're not quite as reliable. Now, they're very reliable, but not as much. So what we do is we draw both of them on here, and then we look for clusters. And clusters are where you get these levels coming together. So here we have yesterday's low and the 23.6, and the market came into there. And here's a more significant one, 38.2, and the mid pivot. The market put in both of its little highs there. Now the market came down again through S1, came down to retest this low here. When it went back up, now this is the key. How would we determine whether it's going to hold S1 or not? Well, it doesn't really hold S1. It goes all the way back up here. It acknowledges it, right? But it really goes higher than after acknowledging it. And it comes back up to the, cluster. Cluster between yesterday's low and the 23.6 Fibonacci. By the way, a lot of people don't use this percentage. I highly recommend you do. And so now this cluster works twice. Now, why do clusters work? Because a lot of people talk about clusters. I'm certainly not the only one who talks about them, and I certainly did not invent them. The reason that clusters work, again, the market logic is that just like you'll have a lot of people looking at the floor trader pivots, and then you'll have other people, some people use them, some people don't, but a lot of people use them. And then there's a lot of people use Fibonacci, some do, some don't. So what you're doing is when you get a cluster, the market logic as to why they work is you have two groups of people. Some are looking at the floor trader pivots, or yesterday's high and low, for example. That's not really a floor trader pivot, it's just yesterday's low, and a ton of people look at that. And then you also have another group of people, market participants, who are watching the 23.6 Fibonacci ratio. So it creates more market participants watching that level and responding to it. They have that on their charts as a support or resistance level. Therefore, they will respond to it by either buying or selling or taking profits. And so the whole reason that clusters work is just that you have more people watching it and responding to it. And that's the logic as to why these levels work. Now, if you like this video, please understand that, sure, it's free. But if you got value from it, you have a moral obligation to pay it forward by clicking on that little share button below and share it on social media. In addition, if you're watching this on YouTube, I invite you to click the thumbs up icon below and leave a comment. Those comments really encourage me to keep giving away free trade strategies. Oh, and one of my favorite trade strategies, which I haven't put on YouTube, is called the rubber band trade. It has a very high win-loss ratio. It's a simple trade. I've got a video that will teach you this in about 26 short minutes, and you can get that video explaining that trade strategy absolutely free by clicking in the image in the top left corner, or if you're on a mobile device, click the little eye with the circle around it in the top right corner of this video. That's an actual trade strategy. Shows you where to get in, where to get out, and the rules. And if you're not watching on YouTube, there's probably a link below or an opt-in form on the side. Once you do that, I'll personally email the video to you with the rubber band trade strategy that you can start trading right away.